Hello and welcome once again to STA 330 Actuarial Statistics. I'm Eunice Frimpong from Accra Technical University, and in today's lecture, we are focusing on a very important concept in insurance, deductibles. Let's begin by reminding ourselves what insurance is. An insurance policy is a contract between two parties, the insurer, who provides financial coverage in the event of a loss, and the insured, who pays a premium and receives reimbursement if a covered event occurs. But the insurer doesn't always pay for the full loss. In most cases, there are modifications to the coverage, like deductibles and policy limits, which help distribute financial responsibility between the insured and the insurer. Now, what exactly is a deductible? A deductible is the amount the policyholder must pay out of pocket before the insurance company starts to contribute to the loss. For example, if your car insurance has a deductible of 1,000 cedis and you suffer a loss of 3,000 cedis, the insurance will only cover 2,000 cedis. That is the portion that exceeds the deductible. So here your loss is 1,000, your loss is 3,000. The deductible in the contract is 1,000. So the insurance company will pay only the loss minus the deductible, which is equal to 3,000 minus 1,000 equals 2,000. So the insurance will only cover 2,000, the portion that exceeds the deductible. This concept has two main purposes. One, to share risk between the insurer and the insured. Two, to discourage small or minor claims. So here is the logic. If the loss is less than or equal to the deductible, the insurer pays nothing. If the loss is greater than the deductible, the insurer pays the excess, that is, the loss minus the deductible. Let's look at this in two cases. Case 1, the loss is less than or equal to the deductible. This means the entire loss is uninsured and the policyholder bears the full cost of the loss. Case 2, the loss exceeds the deductible. Now, this means the policyholder pays the deductible and the insurer pays the rest, which is the loss minus the deductible. So in summary, total loss is equal to the amount paid by the insurer plus the amount paid by the insured. Now, understanding this helps clarify how financial responsibility is split in such an insurance contract. Now, why do deductibles matter? Why deductibles? Deductibles play a cost-sharing role in insurance. They help in the following ways. One, they make sure both parties, which is the insured and the insurer, share in the financial burden. Now, the second thing is that they help prevent frequent small claims, which can be expensive to process to the insurer. Now, the third thing is that they encourage responsible use of the insurance coverage. So from an actuarial point of view, this also helps in managing administrative costs and in pricing policies more accurately. Let's define the insurance payment using variables. So let X be the loss amount, which is a random variable. Let Y be the insurance payment and D be the deductible. Then the insurance payments can be expressed as Y equals 0 when X is less than or equal to D, and Y equals X minus D when x is greater than d, or more compactly, y equals the maximum of 0, x minus d. So this formula gives us a clear rule to compute what the insurer actually pays. Let's focus here for a moment. When the loss is less than the deductible, in the first instance, then x minus d here will be negative because x is less than d. So x minus d here will be negative. That means 0 will be a bigger number. So therefore, y equals 0 when the loss is less than or equal to d. But when the loss is more than d, which means x will be a bigger number than d, then what we have here will be a positive number. Therefore, y will be equal to x minus d because that number will be bigger than 0. So we're looking at the maximum here. So y will be equal to x minus d in the case where x is greater than d. Now we move into the statistical aspect. The expected insurance payments, also known as the net premium, is the average claim amount the insurer expects to pay. If the loss X is discrete, the expected payment is given as expected value of Y equals the summation of X minus D times the probability that X is equal to X, given that X is greater than D. If X is continuous, we use the integral. So the expectation of Y is equal to the integral of X minus D times the PDF f of X dx. And where the integral rounds from D, the minimum value is D, the deductible, and the maximum is infinite. This tells us how much the insurer, on the average, will pay across all possible losses. Now, here are key takeaways. The insurer only pays when the loss exceeds the deductible. The expected payment increases as the deductible decreases. And the value is critical in pricing insurance products. So premiums reflect actual risk exposure. Beyond just the expected value, we also care about the variance, which measures how much the insurance payments vary from the average. To find the variance, we first compute the second moment. For discrete X, the second moment of the insurance payments, which is expectation of Y squared equals the summation of X minus D all squared times the probability mass function, given that X is more than D. Now for continuous X, we have the same system. In this case, we use the integral function and then we use the PDF function. Take note that X minus D is squared. Therefore, we have the variance of Y being given as expectation of Y squared, which is the second moment, minus expectation of Y all squared, which is the first moment squared. Now, this variance helps us understand the risk or uncertainty in the insurer's payments. Let's go through a practical example. Suppose we have a deductible of 4 and the loss X has a probability density function given as f of X being equal to X over 50, where X runs from 0 to 10. We are to calculate the variance of the insurance payments. So first, compute the expectation of Y. So expectation of Y is equal to X minus 4, because 4 is our deductible, times the PDF, X over 50. And our integral will run from D to the maximum, and the maximum is given as 10 according to the question. So the integral 4 to 10 of X minus 4 times X over 50 dx. The next step is to compute the second moment. Now this runs almost the same as the first moment. The only change here is that X minus 4 is squared, indicating the second moment. Everything else stays the same as in the first moment. So finally, you compute the variance using the value you get from computing your second moment, and then you subtract the square of the value you get from computing the first moment. After going through the calculation, you should get the expectation of y being equal to 2.88 and the expectation of y squared being equal to 12.24. Therefore, the variance is equal to 12.24 minus 2.88 squared, which is equal to 12.24 minus 8.2944. And finally, we have 3.9456 as our answer. So this means the average insurance payment is 2.88, and the variability around that average is 3.95. This variance tells the insurer how unpredictable or risky the payments can be. So in conclusion, deductibles are more than just numbers in a policy. They serve to share risk, discourage minor claims, and help insurers manage costs and risk. Understanding how to model and compute the insurance payments, its expected value and variance, allows actuaries to price policies more fairly and efficiently. Thank you for joining me in this lecture. In our next class, we will explore how insurance structures affect risk and payouts, looking at other features like policy limits and coinsurance. Please take the time to review this material and feel free to reach out if you have any questions.